talk about growth in Asia in the securities business. Joining us to do that is Neil Katkov. He is the Senior Vice President of Asia Celent. That's a part of Oliver Wyman. And also with us is Michael Vrontamitis. He is the Head of Product Management, East Transaction Banking at Standard Chartered. Let's talk a little bit about the history of what's been happening in securities across Asia. If you can give us some of your views as to what you think that's been happening over the last few years.
I think one of the main themes in Asia is the development of a mature market structure, such as we've seen in Europe and the US. And mature market structure means you have technology, smart order routing, tying together all the exchanges. You have algorithmic trading that enables high-frequency trading strategies and arbitrage for both speculative and perhaps hedging purposes. And this type of modern infrastructure is desired by many market participants, and some see it as a key to different types of growth, maybe increased volumes. By the way, the first 6 months of 2012 saw declining volumes in almost every market, including in Asia. So the markets right now need some help. But on the other hand, the mature market structure tends to drive down transaction fees and commissions and clearing fees because it's so efficient. So exchanges, brokers, and clearing banks make less money. Now, which is better? Most of the regulators in Asia seem to like the traditional model, keeping the market fragmented, keeping those fees up. Even governments, such as Hong Kong, benefit from a stamp tax they put on every equities trade. So what we've seen in the last few years is really a de facto evolution towards the mature structure with the potential of driving down profits for participants, but regulators trying to hold things back and keep things a bit traditional, and arguments on both sides about which is better and whether it is effective in driving more trading to begin with.
Yeah, I agree with Neil. I mean, I think the market in Asia is very complex. You've got multiple markets, multiple levels of maturity, and some markets are more advanced, Japan, Hong Kong, Singapore, but other markets are less so. And you've got sort of this two types of regulatory environment. Some very restrictive. You look at India, you look at China, very restrictive regulatory environments. The markets are concerned, and the regulators are very concerned about hot money entering the market, particularly when you look at things like QE and quantitative easing from Europe and the United States. So I think there's a need for regulation within the Asian context to protect the domestic economies. They're not very open in some cases. And what you have this, at the same time, you have this trend from the European and Americans and OECD markets to invest more into Asia. And we're seeing increasing flows from the OECD markets into Asia, and at the same time requiring sort of lower cost of delivery, which is creating a lot of challenges in the industry.
How is your bank dealing with that?
Well, I think what we've done is we're a sub-custodian across multiple geographies in Asia, and what we've been trying to focus on is how do we provide a single instance platform that enables companies or investors in the OECD to get access to the Asian markets at local sub-custodian prices. So effectively trying to take a layer of cost out of the equation so that we can help the customers.
How do you see this evolving over the next few years, though?
Well, I think there's a very interesting example with ASEAN Link, which is an attempt to link up several of the markets in Southeast Asia, first on the front end, but ultimately on the clearing side. I think banks are very interested in the first part because having market participants being able to trade more easily across multiple markets opens up great clearing opportunities. Most of the major banks in the region, major global banks, are putting in place enhanced clearing services. They stand to have a very good business there. But eventually, ASEAN Link, for example, plans to have its own clearing as well. That is going to be more efficient, but again, perhaps it's going to remove some of the opportunities for those clearing banks. And we always see this. Whenever technology is introduced, there's more efficiency. You have winners, losers. But then you have new business models that probably open up new opportunities. And perhaps in Asia, there'll be increased participation in this evolving integrated structure by what is now a very isolated market, the Chinese equities market. And that will open up new clearing opportunities, which will be very interesting.
Yeah, I mean, I think China is the biggest opportunity that I see within the Asian context. I mean, China today makes up about 10% of global GDP on a nominal basis. When we look up to about 2030, it's probably going to be around 24% of global GDP. Our research team, through their super cycle report, did some excellent work around this. And what does that mean? Well, if you look at the rest of the world, you see the US moving from 24% to 12%. And in terms of the equity markets, probably Asia is about quarter of the market capitalization, global market capitalization. By 2030, we're expecting that to hit 50%. So, I mean, this is where the action's happening.
Yeah. So if this is where the action is happening, how can you at Standard Chartered as a bank, as we've been saying, if there are all these new models of business that are likely to come in, how do you stay relevant? How do you keep making money?
Well, I think it's it's a technology game. I think Neil made a point around technology, and it's about investing in the right technologies to link all the clearing systems together.
What are you investing in now?
So we're investing in effectively a sub-custodial system that covers the whole of Asia. It's a single instance, so a single platform. You have one window into Asia, and effectively you get a sub-custody platform without having to have a regional overlay.
Is there a role, I mean, we heard from Godfrey Lebrand, the CEO of SWIFT, in the opening plenary when this conference kicked off. We heard from him saying about the enormous amount of work that they still got to do in Asia. You as a bank, you as an operator within this market as well, what does SWIFT have to offer you in Asia, or should have to offer you? That's a good question.
It's a good question. It's a rather good question.
I think as a de facto platform, SWIFT stands to benefit from these increased flows, but it will also face competition because there are alternative networks for passing payments. And I think we're probably going to see more of those, and in a sense, payments might become just as competitive as equities and other investment markets are now, in a sense.
No, look, and I think the other thing that I'd add to that is about standardization. When you look at China and look at the internationalization of the renminbi, there's a lot of challenges in terms of the standards that are applied to that in the security space, in the trade and cash space. So I think from a SWIFT perspective, it's how do we get the standards right so that we can communicate with each other in the most efficient way possible.
A lot of the discussion that we've heard over the last 3 days have been about also what lessons Asia could learn from what we've been experiencing in Europe, in the US. How do you think that applies to you in Asia about the securities market?
I think the scenario I was describing in the beginning of potentially greatly reduced profitability in the traditional model, as the traditional model disappears, is a definite threat in many ways. But I think opportunities might actually lie outside of equities. I've been talking about equities until now.
Yeah.
But there are commodities, there are bonds, mutual funds, exchange-traded funds, and a whole variety of derivatives listed in OTC, a whole variety of products that are all developing in various ways in Asia, often based on both what innovative financial institutions put in place and regulators. The Asian regulators, from the positive point of view, are definitely looking at how markets have developed in Europe or the US and trying to avoid various mistakes that might have occurred. And in fact, some markets are surprisingly very orderly in how they are putting in the regulatory or deregulatory roadmap. And very interestingly, China is one of those countries. You'd sort of expect it to be a little unpredictable or politically swayed by political changes in the country, such as we're seeing now. But actually, from a regulatory point of view, they've been extremely steady and extremely well planned, and very consciously learning from developments that have already occurred in the US or Europe.
And yeah, I mean, I think the regulatory environment in Asia is more restrictive. And what it's done is it's actually protected a lot of and avoided some of the mistakes that you've seen in the European and American context. And what we expect to see is that some of those restrictions stay in place, but the sort of pace of liberalization to continue at the same time. So trying to balance out, say, quotas or restrictions that enable the markets to develop at the right pace. And we are going to see a huge amount of intra-Asian investment as well.
And where specifically, in which countries are you talking about there?
Well, I mean, I think you can look at, say, the Koreans investing abroad. I mean, over the last year or so, we've seen a reduction in net redemptions of Korean offshore funds. And I think, but going forward, we'd expect that to pick up again, particularly intra-Asian, and also the Chinese with their QD program.
Okay, well, we'll leave it there. Thanks very much for joining us, both of you.